Are we looking at a falling knife throwing massive sell signals? Or is this a deeply undervalued stock flashing a generational strong buy? Welcome to the deep dive.
It's the ultimate question, right? And today, we are pointing our microscopes at a company that is quite literally in the laser business.
Yeah, Nuburu Inc. Ticker symbol BURU. If you're watching the markets lately, you know this one is just an absolute labyrinth.
Oh, completely. We are looking at massive contradictions, incredibly volatile price action, and, well, a stark divide.
It's an almost unbelievable divide, honestly, between what the insiders are doing with their own money and what Wall Street analysts are just screaming from the rooftops.
Right. And our mission today is to unpack all of it. We are going to look at the financials, the short-term technicals, and the underlying technology itself.
But before we step into the crossfire, do us a quick favor. Like the video, subscribe to our YouTube channel, and leave your feedback in the comments.
We really do read them all.
We genuinely do. And we want to know where you stand on this massive debate.
Absolutely. And just to set the ground rules right up front, what we're doing today is strictly an educational deep dive.
Right.
We're looking at the recent data, the market psychology, and the financial filings as of late April 2026. This is a natural human debate about the numbers, and it is strictly not financial advice.
Exactly. We are here to read the map, not tell you where to drive.
I like that.
So before we get swept up in the technical momentum or, the sci-fi promises of high-powered lasers shooting down drones, we have to establish a baseline.
Yeah, we need the cold, hard numbers first.
Right. So the stock price as of late April 2026 is sitting around 37 cents. And in its latest session on the NYSE American, it experienced a massive, violent upward spike.
28.8% to be exact.
Yeah, it's huge. I mean, to a day trader watching a scanner, that looks like a rocket ship taking off.
It does. But the wider historical lens tells a much, much darker story.
It's brutal. The 52-week high post-split is $4.25.
And the 52-week low, which it just hit a few weeks ago on March 30th, was just over 15 cents.
But historically, this stock recorded a high near $85.
Wow. Yeah, that is roughly a 99% drop from its all-time highs.
99%. That's just total wealth destruction for early investors.
It really is. If you put in $1,000 back then, you're left with basically enough to buy a bad cup of coffee.
Exactly. And looking at the Q1 2026 financials, it's not hard to see why that happened.
Oh, it's not. The balance sheet reflects a company that is just fighting for its life.
Break those numbers down for us.
Well, based on the latest reported metrics, total assets sit at approximately $49.8 million.
Okay.
However, total liabilities are looming at about $65 million.
Ouch.
Yeah. That puts shareholder equity in negative territory, specifically minus $15.2 million.
So for anyone listening who isn't an accountant, when you hear negative equity, what does that practically mean for the business?
It essentially means that if the company liquidated everything it owned tomorrow, it still wouldn't have enough cash to pay off all its debts.
That's a terrifying position to be in.
It's a ticking clock. The only reason a company can continue to function in that state is because creditors are willing to hold off on forcing bankruptcy.
Because they know if they force liquidation, they'll get, pennies on the dollar?
Exactly. Whereas allowing the company to keep operating might, eventually generate a return.
So it's basically an aggressive game of chicken.
Very aggressive.
Yeah.
And their income statement and cash flows make that game even more dangerous.
Because of the burn rate.
Right. Historically, they have been burning through $17 to $20 million annually in free cash flow.
But they aren't burning that cash on, lavish corporate retreats, right?
No. They are an advanced technology company. That money is being vaporized on heavy research and development.
Just keeping highly specialized engineers on the payroll to refine their laser tech.
Exactly. It used to be fashionable to say a company like this was a leaky boat taking on water.
I've used that one myself.
But really, it's more like a jet engine testing facility. They are burning massive amounts of financial fuel just to see if the engine will start.
And for the last few years, the market has been terrified. The fuel tanks were going to run dry before liftoff.
Right. But that dynamic shifted dramatically just a few weeks ago.
Okay, what happened?
The pivot point for the current financial narrative is a massive cash infusion they recently secured.
Oh, right.
Yeah, as of April 1st, 2026, their cash and equivalents position was bolstered to over $24.7 million.
So they suddenly have a war chest,
Exactly. Management stated this gives them the runway to target a positive equity position by Q2 of 2026.
which instantly reduces the immediate existential bankruptcy risk.
It does, gives them breathing room.
But, I mean, it doesn't solve the underlying profitability issue, does it?
No, it doesn't.
Because if they are still burning $20 million a year, that new $24 million pile of cash only buys them, what, a little over 12 months of survival.
Barely that. The market is pricing in the reality that unless something fundamentally changes about their revenue generation, they will be right back in the same perilous position next year.
Which brings up this incredible contradiction.
Right.
If the fundamentals are that shaky and the balance sheet is technically in negative equity, why on earth did the stock just jump nearly 30% in one session?
Well, that is the million-dollar question, and it comes down to technicals versus fundamentals.
Because that is not standard market behavior for a company with negative equity.
No, but the institutional algorithms driving the day-to-day trading volume, they don't always care about a company's long-term negative equity.
What do they care about then?
They care about momentum. They care about order flow.
Okay, so let's dig into that technical analysis. Because right now, it looks like a tale of two entirely different timelines.
It really is. The long-term trend direction is undeniably a bearish falling channel.
I mean, you do not drop 99% without establishing a brutal multi-year downtrend.
Exactly. But the very short-term picture, it is aggressively bullish.
Because of that pivot.
Yes. The stock established what technical analysts call a pivot bottom on March 30th at that 15-cent level.
And since bouncing off that floor, the stock is up 78%.
78% in just a matter of weeks.
I want to dig into the indicators driving that climb. Because when I look at the relative strength index, the RSI is sitting around 62.9.
Which is running pretty hot.
Right. And for anyone unfamiliar, RSI measures the speed and magnitude of recent price changes. It helps evaluate overvalued or undervalued conditions.
Usually a stock hitting an RSI of 70 is considered overbought.
Meaning it might be due for a pullback.
Yeah. So at 62.9, it's hot, but it is still firmly indicating buy momentum.
And then you combine that with the Anki-D, the moving average convergence divergence,
which is currently sitting positive at 0.021.
Right. Then FCD looks at the relationship between two moving averages. And a positive number essentially means the short-term momentum is accelerating faster than the long-term trend.
And algorithms see that acceleration and they just start piling in.
So the moving averages themselves are acting as the catalyst here.
They are the ultimate catalyst for this breakout. Both the 50-day and the 200-day moving averages are flashing a strong buy consensus.
Give us the numbers on those averages.
So the 50-day moving average is currently down at 22 cents, and the 200-day is at 19 cents.
And the stock is at 37 cents, so it's smashed through both of them.
Smashed through them. Institutional trading algorithms place heavy emphasis on these averages.
So when a stock price manages to break significantly above its 200-day moving average, which in this case is almost double, that average momentum traders see it as a structural shift.
Exactly. They interpret it as a fundamental change in the asset's trajectory.
Okay, so let's lay out the technical battlefield. If momentum traders are flooding into this play, what are the specific price levels they are watching?
They are looking closely at support and resistance. The support floors on the downside are firmly established at roughly 22 cents and 21 cents.
And below that?
Below that, you have a massive psychological baseline at 19 cents.
So if the price drops below 19 cents, what happens?
The entire breakout structure is invalidated. The algorithms will likely flip to selling.
And what about the upside?
On the upside, the immediate resistance, the ceiling the stock has struggled to punch through recently, is 43 cents.
So if buyers can push the price through 43 cents with high volume, what's the next target?
Technical models shift their targets up to 65 cents, which would align with an 80 RSI level.
And eventually?
Eventually a lofty target of $1.05.
Wow. Okay, but we have to introduce a dose of skepticism here, right?
We absolutely do.
Because RSI and Anki-D look incredible on a daily chart. But in a stock that is down 99% from its all-time high, these indicators can be incredibly deceptive.
They can be a total mirage.
Think about the mechanics of short selling. When hedge funds bet against a stock, they borrow shares and sell them, hoping to buy them back later at a much lower price.
They pocket the difference. And if stock falls 99%, those short sellers have made an absolute fortune.
Right. But eventually, they have to buy those shares back to close their positions.
And when millions of shorted shares are suddenly bought back all at once, it creates a massive artificial spike in demand.
Which is what we call a dead cat bounce.
Yes. The old market proverb is that even a dead cat will bounce if you drop it from high enough.
It's grim, but it's true. And short covering rallies are violent and fast, aren't they?
Extremely. The influx of buying volume spikes the price 30, 50, sometimes 80% in a few weeks.
And retail traders see the green candles, assume the company has been saved, and they buy in.
But once the short sellers finish covering, the artificial demand vanishes.
The macro downtrend resumes, and the retail traders are left holding shares that immediately begin bleeding value.
Which is exactly why this specific situation is profoundly confusing.
Yes, because in a typical dead cat bounce, the company insiders, the executives who look at the negative equity every single morning, they use that artificial spike as exit liquidity.
They dump their shares while the retail traders are buying.
But that is the absolute opposite of what is happening with Nuburu. We are seeing a staggering bullish signal from the absolute top of the leadership chain.
We are. In April 2026, co-CEO Luca Zamboni indirectly acquired $1.5 million in company stock.
$1.5 million of his own ecosystem's capital.
That single acquisition forces analysts to pause. We are talking about a company trading at 37 cents, staring down tens of millions in liabilities.
And he's deploying that much capital into the equity.
Yes. And zooming out to the quarterly totals, insiders have accumulated approximately 355,500 shares over the last 3 months.
That's a ton of accumulation.
But the critical metric here isn't just the buying, it's the lack of distribution.
Meaning they aren't selling anything.
Exactly. There have been 0 reported insider sales during this period. Nobody in the C-suite is taking profits or jumping ship.
So even though insiders only own a fractional amount of the total float, I think it's about 0.41%, their aggressive buying is significant.
It has pushed the insider power score to a maximum positive rating. It is a blinding show of internal conviction.
But that insider conviction crashes headfirst into Wall Street's analysis.
It does. It's a complete train wreck of opinions.
Because if you look at the institutional sentiment, they are staring at the exact same balance sheet and the exact same technology.
But their consensus rating is currently sitting between strong sell and hold.
Strong sell. And the median short-term 12-month price target from analysts is just 11 cents.
11 cents. Meaning they think it's dangerously overvalued even at 37 cents.
How do analysts even arrive at a target like 11 cents?
Through discounted cash flow models and probability weighting, they are projecting the company's historical cash burn forward.
Even factoring in the $24 million infusion.
Yes, and concluding that the company will inevitably have to issue millions of new shares to survive another year.
Ah, so dilution. And that future dilution inherently destroys the value of current shares.
Exactly. They believe the current valuation is an anomaly, overvaluing the company by more than 2/3.
It is a phenomenal paradox. I mean, it's a heavyweight fight.
It really is.
You have the co-CEO wagering $1.5 million that a massive turnaround is imminent.
And on the other side of the trade, you have institutional analysts structuring models that predict total capitulation down to 11 cents.
There is zero middle ground here.
Yeah.
Someone is going to be spectacularly, embarrassingly wrong.
Completely wrong.
So what is the catalyst that makes the co-CEO look like a visionary? We have to explore the bull case here.
And it all revolves around what these lasers actually do.
Right. Because Nuburu doesn't manufacture barcode scanners or presentation pointers.
No, they pioneer high-power blue laser technology. And the fundamental bull case is entirely anchored to commercialization in high-budget sectors.
Like the defense contracts they recently landed.
Yes. They recently secured 2 highly visible defense contracts, one for $250,000 and another for $850,000.
Okay, but to a company like Lockheed Martin, $850,000 is the budget for a holiday party.
That's true.
So why is a sub-$1 million contract supposed to save a struggling company?
Because the value isn't in the immediate cash. It is the proof of concept in 2 of the most lucrative modern sectors.
Which are agritech and counter-drone defense.
Exactly. And the mechanics of blue lasers are what make this compelling.
How so? Like, what's the difference between blue and normal lasers?
Well, traditional industrial lasers, which are often infrared, tend to reflect heavily off certain conductive metals like copper and aluminum.
So a huge percentage of the energy just bounces off harmlessly.
Right. Blue light, however, is absorbed by these metals at an incredibly high rate.
Oh, interesting.
This means a blue laser can cut, weld, or melt these materials vastly more efficiently, using way less power with insane precision.
Which is exactly what you need if you are trying to shoot down a hostile drone made of aluminum and copper wire moving at high speeds.
Exactly. The military is obsessed with counter-drone technology right now.
Because cheap, weaponized drones have completely changed modern battlefield tactics.
They really have. A $1 million missile to shoot down a $2,000 drone is economically unsustainable.
But a directed energy blue laser that only costs a few dollars in electricity per shot.
That changes warfare entirely.
Wow. So if Nuburu's technology becomes a scalable standard component in military defense systems,
Then those initial small contracts will turn into massive multi-year procurement deals.
okay, I see the bull argument. They are saying, with the 24 million buying them time, getting in at 37 cents right now is like buying a prime defense contractor at a garage sale.
That's the dream. But the bear case relies on the brutal gravity of the market.
Okay, puts it back to earth.
The bears completely discount the future promises of defense contracts. They point straight to the company's historical capital management.
Specifically the use of reverse stock splits, right?
Yes. A reverse split is a mechanical maneuver where a company consolidates its existing shares into fewer, higher-priced shares.
Like taking 10 shares that are worth 10 cents each and combining them into one share worth $1.
Exactly. The company's market capitalization hasn't changed by a single penny.
They didn't invent a new product or make a profit. It is purely cosmetic surgery for the stock price.
And that cosmetic surgery is almost exclusively used as a life support mechanism.
To maintain compliance with stock exchange listing requirements.
Right, because if a stock trades under $1 for too long, the exchange will delist it.
Which cuts it off from major institutional capital.
Bears argue that a company repeatedly relying on reverse splits to avoid delisting is basically proving its inability to organically grow value.
They see the 24 million infusion not as a launch pad, but as just another patch on a tire that has already blown out.
Exactly.
And this introduces the most dangerous element of this entire debate for retail traders, the liquidity trap.
Yes, the liquidity risk here is severe.
I call this the Roach Motel phenomenon.
Oh, that's a perfect analogy. Explain that.
Well, a stock trading at 37 cents with hype around military drone lasers looks incredibly tempting on a message board.
It does.
It is very easy to check in. You drop a few $1,000s and secure a massive number of shares. But Nuburu has a relatively low average daily volume compared to a major tech stock.
And the order book mechanics on low-volume stocks are incredibly unforgiving.
Right, because volume dictates how easily you can buy or sell without moving the price.
In a highly liquid stock, if you want to sell 10,000 shares, there are thousands of buyers waiting at that exact price to absorb your order.
But in a Roach Motel scenario, the bid-ask spread widens aggressively.
It does. Imagine the company misses an earnings target or the cash burn accelerates.
And everyone decides to sell at the exact same time.
You want to sell your 10,000 shares at 37 cents. But because the volume is so low, the order book only has a buyer willing to take 500 shares at 37 cents.
And the next buyer only wants 1,000 shares at 32 cents.
And the buyer after that is down at 25 cents.
So your own attempt to sell actually crashes the price against you as your order falls down the book looking for anyone to take the shares.
You literally cannot check out of the position unless you accept a devastating loss.
The value trap just snaps shut.
It does. So synthesizing all of these moving parts, the new cash runway, the deep negative equity, the insider accumulation,
The 11-cent institutional target and the blue laser physics.
we have to separate the outlook into two distinct time frames, short-term and long-term.
Okay, what's the short-term outlook? Like the next few weeks?
The short term will be dictated by pure technical warfare. Volatility is the only guarantee.
Right.
If momentum holds the stock above that 32-cent support level, traders will aggressively push to test the 43-cent resistance.
And if they break it, volatility spikes upward.
But if the volume dries up and it drops below 28 cents, the technical chart breaks down.
The algorithms will trigger sell orders.
And a rapid slide back toward the 15-cent lows is highly probable. It's a failed breakout.
And what about the long-term perspective? Fast forward towards the end of the decade, past all this daily noise.
Looking toward 2030, the variance in predictive models is staggering.
I can imagine.
Aggressive long-term models map a potential path up to 96 cents.
Okay, but that's a big if.
It is entirely exclusively dependent on their proprietary blue laser technology becoming an indispensable standard in defense or industrial manufacturing.
Before they burn through the new 24 million cash pile.
Exactly. If those defense contracts remain small proof-of-concept projects, the cash will evaporate.
The analyst's grim 11-cent target becomes a near certainty.
It's the ultimate high-wire act, being performed without a safety net.
The sheer uncertainty, the fundamental clashes, and the opposing financial forces at play make this an incredibly fascinating case study of market mechanics.
It really is, which is exactly why this conversation has been an analytical debate of the data and not a recommendation to buy or sell.
Definitely not.
It perfectly highlights the danger of tunnel vision in investing. If you only look at the MASD momentum, you see a guaranteed winner.
But if you only look at the balance sheet liabilities, you see an immediate bankruptcy.
You have to synthesize the entire ecosystem to understand the true risk profile.
The whole picture is what matters. And it leaves us with an incredibly provocative reality to consider. We are entering an era where critical, paradigm-shifting national defense technology isn't just being developed by massive, stable conglomerates deep inside the military-industrial complex.
Right.
It is being pioneered by volatile, microcap companies fighting for survival on the open market.
Entirely dependent on retail sentiment and technical algorithms, just keep the lights on long enough to finish the research.
Exactly. What happens to national security innovation when the technology actually works, but the balance sheet fails?
It's a scary thought.
It's definitely something to think about. Wall Street algorithms say this company is sinking to 11 cents.
But the co-CEO's wallet says the defense contracts are about to change everything.
So when the dust finally settles on this blue laser battlefield, whose side of the trade would you rather be on?